Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. U.S. economy and markets are showing remarkable resilience in the face of a historic rate hike cycle and ongoing tightness in the labor market. Joining me to discuss, we have Tilley, chief economist of Wilmington Trust. Luke, it's great to see you as always. Welcome back to Trade Talks.
Thanks for having me back.
Why do you think markets are digesting the macro backdrop in stride?
Yeah, as we've moved through this year, we've just seen increasing amount of data that really pushes more towards the soft landing argument. Consumers continue to spend, they're slowing down, which is helping with inflation, but it's remaining positive. We've seen a lot of capital expenditures slow down as well, but it's keeping its head above water. And of course, those are the two biggest parts of GDP. And then if you just look at the labor market, 209,000 jobs added last month, which is a steady slowdown from what we've seen over the past couple of years. But if you looked at pre-COVID numbers, that's still a pretty strong number. And I think that's indicative of what firms are thinking in terms of their order books going forward, what the kind of work that they have to do. And they're just happy that they're able to make that many hires. And I think it all brings it together for a macro economy that has held up really well in the first half of this year compared to what was expected.
Do you expect earnings for the second quarter to be challenged?
Yeah, this is supposed to be the last quarter of earnings. It is in negative territory before returning a little bit positive next year. If we look at it and think about what is the typical beats, then it could be negative 3% instead of negative 7%. And I think that's really positive. If you think about the environment that these firms are dealing with, it's where their ability to push on those price increases has really come down with inflation slowing down and consumers being a little bit more selective. But they've still been dealing with really high wage growth. And for a lot of these firms, that's the biggest cost out there for them. But even with that, what we see is a lot stronger productivity. They must be squeezing productivity out of those employees because they're costing them so much, but they're still able to post profits. So obviously, our earnings are still challenged in this quarter, especially for some sectors of the market. But broadly, it looks like a positive story going forward after that, Jill.
Outside of tech, is the rest of the market fairly valued?
Yeah, if we're at 20 on a PE for the entire market, when you pull that out and look at when you pull out tech, you've got 17 or 18, which is still high by historical standards, but it looks a lot better than when you just include tech. And over the broad look, if you think about the risks of recession, it definitely looks like it's priced pretty reasonably. There are some sectors much lower than that, so there are some opportunities in those other sectors, Jill.
So then do you think that too much is being made around narrow market breadth, or do you think it's starting to improve? Or to your point, there might be opportunities for investors here?
Oh, yeah, I think that there are opportunities. And I think, a lot of ink has been spilled on the narrow market breadth, and especially because we typically look at things on a year-to-date calendar basis, understandably so in our business. But you look over the past year, the equal weighted SPX is up about 13%. And even for this year, it's up about 7%. And then if you look at small caps, they're pretty strong too, 12 and 13%, whether you're looking year over year or year to date. And I think that's a really encouraging turn over the past month or two, where you're starting to see broader success and more participation across the market. And there are going to be some opportunities there, especially if that soft landing story plays out.
Let's talk about AI for a moment, but from a different perspective. Europe may take the lead on regulation of AI, much like its approach to data privacy in response to the rapid growth of social media. This could mean stronger adoption in the US than Europe and the rest of the world. Why do you think that is?
Yeah, this is coming along at a time when employers really need it, right? Even if you have such strong labor force growth this year, you've got a lot of people who have retired, you've got a demographic shift, and companies are going to need a way to do more with less. And AI, although it's not fully formed and not fully functional and ready for go time yet, is probably going to plug that hole pretty nicely. And if you do get that regulatory environment turning out the difference between the US and overseas, then that really enables US firms to make the most of it more so than a lot of other regions around the world. So that should be pretty bullish, especially on a longer term look, Jill.
All right, Luke, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.